Hey everybody, Tom Schmidt here on behalf of Ticker Tape Investments. We're here to talk tonight about how to spot the best investment deals. I'm going to go ahead and jump right into it. Tell you a little bit about what to expect tonight. First of all, it's not a sales pitch, and this is an investor empowerment session to help educate all of you guys on some sort of tips and tricks for finding the best deals, vetting deals, avoiding pitfalls, etc. And I mean, we obviously travel around the country, meet with hundreds of investors every year, hear all of your complaints, concerns, pain points, all that stuff, and all kinds of frustrations from, hey, I invested in the deal and I didn't know there were these fees, or I didn't know that this was going to happen, or that these guys were paying themselves this much, or they sent me these projections and then nothing turned out anything like the deal was supposed to be. Or I was locked up for a long time and didn't see that coming. I haven't had access to good deals. And so we'll help you kind of navigate some of those challenges, make sure you're aware of them on the front end, because let's face it, there are an enormous number of investment opportunities out there that are not worthy of your money or your time. And so how do you kind of get access to more deals, but yet the better deals? And so that's what we're going to work on tonight. And one of the big things is a vetting framework where we're going to give you kind of a little outline you can follow that'll cull out a lot of the bad deals, the ones you don't want to get involved with, and the ones that have some sort of problems. Also, one of the key things when you're looking at an investment opportunity is ask questions. Ask lots and lots of questions. If you don't know what questions to ask, reach out to me or Rita, and we'll send you our due diligence checklist. We'll send you a list of questions to ask before you invest, all these sorts of things to get you prepared. But those of you who don't know, I'm an attorney, and I've been representing investors now for almost 30 years when they've lost money in deals. And one of the things that always makes me shake my head, a little shake my head or hands over the face emoji, is when I asked, did you not ask him about that before you invested? No, I didn't. Did you read the pro forma before you invested? No, I didn't. So make sure that you have the confidence to ask questions and know what to ask and maybe even what not to ask. And we'll talk about some real world examples. One of the things that people ask me all the time is, why did this fail? How did I make this mistake or whatnot? And some of the things we've seen over the years in investing in hundreds of deals, seeing thousands of deals, and representing hundreds of investors is most often investors are making very common mistakes. They're not conducting sufficient due diligence, or maybe they don't know how to do due diligence properly and what items to focus on as opposed to the red herrings, if you will. Number two is overpaying in fees. We'll get into that in a little more detail, but there's multiple levels of fees. It's not just like management fees or financial advisory fees. They could be salaries to the principals in the deal, could be a split of profits in the deal, etc. Number three, a big mistake people make is they only see 3 deals and they invest in 2 of them. So that's a terrible thing. You want to be investing in about 1 out of every 10 that you see. And that's hard for most investors, and I get it. We'll talk about some ways you can sort of cheat and short circuit that analysis to do a better job. Number 4, oh my gosh, negotiate, right? If the company says, hey, we'll sell you shares for $10 a share, at least ask, hey, I'll give you money, but I only want to pay $8. Or if 1 unit is $50,000 in the deal, say, hey, I tell you what, I want 3 units, but I only want to pay $120,000, not $150,000, something like that. But negotiate, try to get a better deal. The worst thing that can happen is they say no, right? Another one that people kind of fail to take advantage of is look for deals that have downside protection. If you're making those mistakes, you're going to be taking more risks. You're going to be investing in deals you shouldn't be, and you're going to be missing out on what can be very significant returns on deals you could be investing in. Some of the pain points we hear all the time: I don't know who to trust. I see these guys, they seem nice, they talk smart, they're very slick, they seem to have a very pretty presentation, but I don't know whether to trust them or not. I can't tell hype from substance. I don't want to lose my money. I'm scared to lose my money, but I realize if I'm not investing, I'm not going to make any money either. And the key point here is get involved with, first of all, get involved with Ticker Tape. We're a great resource to help with a lot of these things, but we shouldn't be the only one you're involved with, right? Get on social media groups for investors, get in chat rooms, all those sort of things, and share your pain and run different deals by different people. I'm going to jump right into our deal spotting framework. This is something that you can use going forward. It's not perfect. There's obviously about 107 of these points that you should use, but if you stick with these 6, it'll take you pretty far in the process. Number 1, these are the 6 pillars of a smart private deal. Number 1, transparent and of course favorable terms. So I put that favorable on there because it's not just enough if they tell you what the terms are. You need to make sure that compared to other deals in the market, it's a good deal. Detailed financial pro formas. Now, a lot of investors we work with aren't CPAs, accountants. They're not good with spreadsheets. They're not good with financial statements, all those things. And I get it. It's not as important that you understand or verify the financial projections. What's important is that the management team that you're investing with understands them, knows how they work, knows where the stress points are, and knows how to deal with them. We'll talk about that more in a second. Number 3, and I harp on this all the time. If you've seen my 6 keys to successful private equity investing, you want to make sure that the principals, the guys driving the ship, have the same incentives you do. In other words, you don't want them having Class C shares and you got Class B shares. You don't want them having options to obtain more shares if they're not tied to their success. You don't want them getting 100% of the upside of the deal after you get your 9%. You want their motivation to be aligned with helping you do better. You want to make sure there's a clear exit strategy, and I should have put in parentheses, and credible exit strategy. You want to make sure the team has operational competence. This is probably, aside from not enough capital, in other words, the business is undercapitalized, having poor operators is probably the #1 reason that businesses fail. And then last, what's the risk mitigation strategy for the investors? Is there real estate underlying the project that is under leverage so that there's equity in the real estate? Is there equipment? Are there streams of cash? What kind of sort of fallback is there if stuff goes wrong? All right, pillar number 1, transparent and favorable terms. So here, the first thing is you want to make sure they're not trying to hide the ball, and you want to sniff out if you feel like they're hiding the ball, they're not clear about disclosures, they're not clear about how much money they're making, what's in it for them, if you will. That's a red flag, right? You want to make sure they're not hiding the ball. You want to make sure there's nothing vague in there, there's no wiggle room for the board to change things, etc. You want to make sure there are clear fee structures, whether are they getting an acquisition fee. A lot of times I see deals where they talk about a certain portion of the fees, let's say management fees over here, and they sound really reasonable. What they're not telling you is they're taking a massive acquisition fee over on the other side. Do they get some sort of promote? What is their carried interest? Is there an annual fee? Yeah, there's one on there. Are the fees front loaded? So that's where, and Ticker Tape does this, where we charge 2% per year to manage the asset, the funds, and we take that fee up front for 5 years worth. So we take 10% of the principal out, but that's always disclosed on the front end. You want to make sure you understand exactly what that looks like and how is that going to affect my return as an investor on the back end. I see what's the profit split. One of our investors from Southern California, he knows who I'm talking about. We had hours worth of conversations with him about different real estate deals and deals that he was in, multifamily properties. And I asked him, he was telling me about one deal he was thinking about investing in. I said, well, what is your profit split on the back end? He's like, well, it's not. I get a preferred return of 12%. I'm like, well, 12% is nice, but the guys that are running the show are keeping 100% of the profit, of the upside when they sell the property. That's crazy. the deals that we're investing in, we're negotiating between 70 and 80% of the upside going to the limited partners or the investors. And so that's something that, you got to make sure you're getting a good deal. What is the profit split? Is it reasonable in the marketplace? Pillar number 2, realistic financial pro forma. A friend of one of the utility rescue partners founders used to say that all projections are wrong. Some projections are useful. And so you got to understand that, right? Like any business, when you prepare a financial pro forma, it's virtually impossible to make it accurate. The question is, was it reasonable? Does it provide a guide? Is it useful to the management team to guide their efforts, et cetera? And you want, this is one of the reasons why management teams are so important, because you want guys that have scar tissue. They've learned lessons. They know how to pivot. If what they thought was going to be a killer deal turns out not to be, they got to be able to pivot and make it change. A couple great examples of that. My all-time favorite is a personal one, not for investors. My old partner and I were about to start a law firm, and we were quitting very high-paying jobs at an existing firm in order to start our own practice. So we built this pro forma. We listed out all the clients, and we estimated how much revenue was going to come from each client over time. And oh my goodness, it was so wrong. It was ridiculous. Almost every assumption we made turned out to be incorrect. But at the end of the day, we made more money. In other words, it was new clients we didn't see coming that came in, and we said, oh, this client is very lucrative. Let's go get more clients like that. It wasn't even in the plan, but we were able to pivot and adapt and turn what was kind of a crazy situation into a very profitable one. Another great one is we started an electricity company. You may have heard me talk about it, Pulse Power. And that came out of my partner, Rob Cantrell, and I having been involved in prior businesses. And one of the big clients that we had was a group that organized hundreds of apartment complexes. And so they brought us apartment complexes where we would supply the power for the common areas. And the idea that those deals didn't really make any money, but the idea is that, hey, we're the provider for the apartment complex, so we'll be able to sign up all the tenants and make a ton of money from all the tenants as individual clients. Oh my gosh, total failure. We had 5 brands that we operated under at the company. One of them was specifically for that funnel, that pipeline, and it literally never produced anything. We got maybe 100 clients or something out of 300,000 at the business from that channel. But you know what we did? We pivoted. Said we very quickly identified, hey, as bad as we want this to work, as much as we think it should work, as much money and time as we've invested in that channel, we're going to pivot to something that is working, and boom, lights out. The company booms, goes up, and we sell the business to Shell Energy 3 years after it started, with as the 5th largest residential electricity company in Texas and number 10 in the United States. But it was the management team being able to identify the failure and pivot that makes a big difference. When you're looking at the pro formas on the front end, you want to ask questions like, hey, what happens if sales plummet or sales don't achieve what you're looking for? What happens to the bottom line? Are you going to run out of capital? How much of a capital cushion do you have? Are you going to have to make a capital call? This was a big deal in the last couple of years in multifamily deals because of interest rate changes. All of a sudden, properties couldn't handle their adjustable rates, or they had to make additional deposits into the prepayment of the mortgage and stuff like this. So they would make capital calls on investors. You need to know what's the elasticity, what's the sensitivity analysis to know, am I going to get into that situation with this deal? If it's some sort of early stage business, or let's just not say it that way, not in terms of stage, but if the business isn't cash flow positive yet, and you're investing in it because you think it's going to get there, how much runway do they have? What's the backup plan? How much dry powder is there? Do they have access to other investors? Because the last thing you want to do is come in as an investor, and then all of a sudden you're the one who's on the hook to either write another check involuntarily or let the business fail. So you want to make sure you're analyzing all those things on the front end. Pillar number 3, aligned incentives. As a lawyer, one of the most heartbreaking things I ever saw was there was a very wealthy radiation oncologist in Houston who had an opportunity to invest in a deal where they had a patent for what they called distance-based education. And they had a company, he invested $300,000 of his hard-earned cash in the deal, and then stuff started going badly, and he's like, all right, well, fine, give me the patent and I'll walk away. And they said, oh, well, you don't own the patent. He's like, what do you mean? He said, well, the patent was owned by a separate company that we own, and we just licensed it to the company you invested in, and so you don't have any, we've terminated that license, you don't have any rights to the patent. And so again, you had principals that owned their equity in a different company, and so they had a different alignment of incentives from the shareholders, right? You want everything be performance-based, you want low management fees, low salaries, low all those sorts of things, to allow the people to earn more money when investors get more money. Make sure those incentives are aligned. You want them investing cash, right? Part of it is not just positive alignment, you want negative alignment, right? Hey, if Tom invests $100,000 in the deal, and the company fails, Tom loses $100,000. What do the founders lose? Anything? Or are they on the hook for debt? Are they going to lose their job and that be it? Or have they invested their cash in the deal so that they're going to lose their money too? You want to, I always say, skin in the game. I never invest in principals who don't have their own cash invested in the deal. Not to be confused with I'm giving up some salary. Oh, I deserve a $400,000 salary, but I'm only taking $150,000, so I get credit for $250,000 invested in the deal. That's not a thing. As soon as I hear that, I'm out, right? I want to make sure they're actually writing checks from money they've already earned that's going to put them in a position to be successful. Pillar number 4, you want to make sure that there is a clear exit strategy, right? This is a little trickier maybe than what it sounds like. You want to ask them, what's the exit strategy? You want to listen to it, make sure it's clear, credible, reasonable, and timely. That is soon, right? You should always assume that the estimate they give you for the exit time frame is they're gonna make it sound shorter than it really is. And so if they say 7 years, you want to hear 9 or 10 years, which probably means you don't want to be in the deal, right? You want to have shorter time horizons because you want to recycle your cash. You want to get your money out plus a profit, stock some away into savings, and then put the rest in a new deal and turn it over again, right? Is there a refinance opportunity? This is one of the reasons we like real estate deals that are sort of either turnarounds or maybe upscale. Hey, it's a Class C property, we're going to turn it into a Class B, raise the rents, because once you've done some of that, you can then refinance and take cash out. But you want to be very clear on how are we going to exit? Is there a backup plan? Because again, I don't know if y'all have heard me talk about before, there's a bell curve of possible results that can happen when you invest. At the bottom end of the bell curve there's a small percentage of deals that just fail and you get zero back. At the other end of the bell curve, there's a small percentage that are going to be incredibly successful. You're going to get 9 times your money, 10 times your money. In the middle, the fat area of the bell is the deals that just kind of survive, and your money ends up tied up for 15 years with no exit in sight. And so that's what you want to watch out for. Pillar number 5, operational competence. Make sure the team knows what they're doing. Is the business efficiently run? By efficiency, we mean speed and quality with reduced costs. How does the cost structure of the business look compared to what it should be, what other businesses in the industry are doing. Ask them that. How does your cost per unit or cost per acre or cost per sale compare with your competitors, right? Make sure that you're investing in a team that has worked together before. That's critical. Hey, we just hired 3 new people, a CFO, a COO, and a chief technical officer. Those 3 people may not get along, right? One of them may have a crush on the other one, and then that one's spouse gets angry and somebody's got to quit, and now all of a sudden your investment's at risk. I much prefer to invest with teams that have worked together in the past and have some sort of track record. I want guys that have had wins and exits in the past. I want to know your bio. I want to know what you've done in the past. What were your prior exits? Hey, did a business fail? That's not necessarily the end of the world, because remember, I want them to have some scar tissue, but I want to understand that. I want them to disclose that, and I want to see a track record that these guys know how to exit, the business. Pillar number 6. Last and not least, risk mitigation. What is your downside protection? If the business fails, what happens to the assets? Am I a shareholder investor where I get paid last, or am I a creditor because I've got a convertible note where I get paid first? What sort of preferred return am I getting? Because we were just talking about this on our, we're doing a vacation rental deal that just launched yesterday. If you guys didn't get the link to the presentation, give us a shout and we'll get it for you. But we're investing in 18 houses in the St. Louis market. We think it's an awesome little niche deal for vacation rentals, and there's a preferred return associated with it. Well, there's a very good likelihood. I mean, I'm not telling the principals this, but there's a very high likelihood on deals like this that the investors and us will get our 7% preferred return and nothing else. And the principals who are expecting to get a share of the upside over and above that 7%, the most likely result is they get little or nothing, because that 7% preferred return is a big thing. And that allows me to start taking my money off the table as we go. And remember, the management team, if there's a preferred return, the management team is highly motivated to make that happen. And so, so they are highly motivated to pay me my preferred return, because they don't get their profit share until after I get all of my preferred return. Are there assets that are income producing that I can take out of a failure of the overall business to try to recoup some of my money? How is my capital protected in sort of the worst case scenario that that stuff goes wrong and the deal fails? Let's go through a couple case studies. The first one is a winning deal for Ticker Tape Investments. I want to give you a good example first. So this is an apartment complex that we invested in weirdly, coincidentally, outside the St. Louis market. It's technically in Illinois, but a suburb of St. Louis. And it was far and away the scariest investment I've ever made. This is a significant apartment complex that is built on top of an old coal mine, and they had what they call mine subsidence, which means the ground dropped 8 feet here. It is called, I can't believe I'm gonna say this out loud, it is called Long Acre Ponds because there's a bunch of sort of sinkhole looking things that they just filled in with water and made ponds. So when you go to this complex, the first thing you think is, hey, this is really cool. There's a lot of water, around the complex. And then you start looking at it, you're like, well, there's way too much water around the complex because there's a lot of them. But by the time we got to the property, a couple things. Number one, it had been foreclosed on by Fannie Mae, and the partners that are the principals in the deal had been running it for over a year on behalf of the bank, on behalf of Fannie Mae. We bought it out of that foreclosure. And at the time, we were able, because our management had been running the property for over a year, we knew that all the subsidence, number one, was done, and number two, had been repaired. So we had none of that liability or downside. But the cool thing is that the insurance companies hadn't paid in full the reimbursements for that. The way it worked is the insurance company holds the money for a period of time to make sure that there's no more work to be done. And so at the end of the day, we're getting a huge influx of cash that completely dynamically changes the underwriting of the overall deal because in a typical apartment deal, you don't get that kind of thing. A similar situation existed with this vacation rental deal I just mentioned, where they're getting credits for renovating historical properties. That credit they will then sell to a third party for cash, and they're going to distribute that cash to the investors. Again, these are little things we look for winning deals. We have in this Longacre Ponds deal, we have a preferred return. The operators get a success fee as the property generates profit and returns our capital, and when we sell and all those things. And so those are sort of the recipe for a very successful deal, as this is turning out to be. And I think this is going to end up being something like 3 times our money on an apartment deal, which is sort of unheard of. You never expect to get that kind of return. Here's another case study, not so positive a result, type match. I like this one because, again, remember the middle of that bell curve, the most likely thing is that the business won't fail, but there won't be an exit. You'll just kind of be tied up. And that describes where we are in type match. So we invested in a startup, pure startup, mobile dating app. This company has a pretty cool business plan, which is instead of like looking at a photo and swiping right, you go into the app, you take a Myers-Briggs personality profile test, and then it suggests people who have personality types that are compatible with you. And so really cool idea. Great software. The CEO is an influencer who is very popular in the personality profile test industry. Great valuation. They had crypto and NFT integration for kind of a little bonus deal for us, but the company has not been successful. And the reason why is one way to say it, you've probably heard me say before, will the dogs eat the dog food? Speaking of that, I'm rubbing on my dog under the table while I'm talking. But will the dogs eat the dog food? This company was not able to get tons of customers, and we needed a critical mass of customers in order for the app to sort of work. And so I knew this going in. I told the ticker tape partners that we had this is a very high risk proposition, that it's very difficult to get traction with that. And so we told everybody make small investments. So we don't have a lot of capital tied up in this one, but it's a great lesson. It is so easy for a promoter, somebody to start, a founder, to say, hey, I built this software, this website, this mobile app, this shoe, this shirt, whatever it is, it's car, and say, man, everybody's going to want one. They're great. Look, see, it's great. The problem is it is really, really hard to take something from nothing and get a lot of people to choose to buy it. You might say to yourself, hey, it only costs $10. It's not a very big lift. In fact, Type Match was offered for free. But just for someone to engage in that transaction is very difficult. You want to make sure before you're investing in this deal, you'd rather pay 5 times the share price, after they have a couple 100,000 customers, right? That's when you want to get in. That's how you reduce your risk. Generally speaking, some red flags that we've seen, and of course, again, I could make a list of these, a mile long, literally. Financial projections that look too rosy, unreasonable, don't compare with other businesses in the industry. And a lot of times you'll see the numbers of sales, revenue, profit, expense are not unreasonable. What's unreasonable is the timing. In other words, they may show they add 10,000 new customers per month, but in reality, they're going to add 1,000 a month. And it's going to take 10 times as long, and there's not enough capital to get there. So analyze those financials. If you're not a CPA, spreadsheet expert, don't want to spend the time, don't have the time, turn it into questions. Give them questions. It's almost like a test. Do they know how to answer your questions about the financials? Things like, have you stress tested it? What is the tolerance for reduction in sales not making the company go bankrupt? That sort of thing. Man, again, if I can't see hard evidence that the dogs are eating the dog food, I'm not investing. And this is big, right? So I can make a new dog food. I can tell you it's healthier. It's going to make your dog's coat shinier. Your dog's going to live longer. Your dog won't get heart disease or whatever I can say. But if dogs don't like it, ain't nobody going to buy it. I'll be able to get a few people to buy a bag, but they ain't buying a second bag, and I'm going out of business. I learned this from one of my mentors a couple decades ago. Before they get my money, I have to be convinced that the dogs are eating the dog food. The way it was told to me was, will the dogs eat the dog food? Because we were talking about a what do you call it, a startup opportunity, a pre-revenue opportunity. I don't even do those anymore, right? I need to see hardcore evidence that people are consistently eating the dog food, buying the product, using the service, etc. Number three, no sponsor investment. How much have you invested? Now, again, if your founder is a multimillionaire, you want to see a significant cash investment. If they're a young kid who's, fresh out of college or something, perhaps they put less money in. It doesn't matter the actual amount they invest. What matters is how important is that amount to them. If you're, a 26-year-old kid out of college, a $25,000 investment is enormous. If I came to you and said, hey, Tom Schmidt, I got a business, I put 25 grand in it, you should invest with me, you'd be like, whoa, no way. Tom, if you're not in it for more than 25 grand, I'm not coming in. So make sure you check on that. Management track record, you got to find out. Have they filed bankruptcy? Have they had businesses go out of business? Have they lost their job? What's their credit rating? These kinds of questions are very important. Fees are a big thing, fees and salaries, right? I've seen deals where they say, oh, it's a 9% preferred return and you get 60% of the profits, Mr. Investor. Well, that's great, except that they're paying themselves such high fees and salaries that there's not going to be anything for me to get 60% of, right? They're barely going to survive. And so you want to make sure, again, that those interests are aligned. And that's what it means when it says GP, general partner versus limited partner alignment. Make sure that that the founders, the guys running and steering the ship, have the same incentives that the investors do. Deal flow is critical. The guys that tend to have the most successful investing track records have seen, evaluated more deals than others. You got to find a way to do that. Ticker tape is a great way, because every deal that we bring to you guys, like the vacation rental deal we just brought yesterday, we've turned down about 7 deals just in the last 45 days to get to that one. And so that helps you, even though you didn't see all those deals, we did, and this was the one we picked as the best. That's who you want to look for, is somebody else who's doing that work for you. Are the risks vetted? Are there better terms? You want to find curated deal flow if you can. And by this, I don't mean somebody who's done 10 multifamily deals, because what he's doing is he's buying whatever multifamily property he can find and then offering it to his investors. You want somebody who steps back a couple levels and looks at lots of guys putting multifamily deals together, sees 20 or 30 of them at a time, and picks the ones that are the best. That's what you need. And if I were you, what I would do is I would join Ticker Tape and say, okay, Ticker Tape is one of my tools for doing that, but I'd go find 2, 3, 4, 5 others, and then you really kind of spread out where your money goes. Why would someone want to participate with Ticker Tape? First of all, we're doing deep diligence on all these deals. We've been investing for 30 years now. Is that right? No, sorry, 25 years now investing. And so I'm a lawyer. I've helped clients do due diligence. We have detailed due diligence checklists for every deal. We even go through a process where there's like a very high level, shallow search. If they check all those boxes, then we move to the deeper. A lot of times we can just eliminate deals right off the bat. Remember things like, what did the last slide say? Hey, the sponsors aren't investing. Hey, the management has something wrong with their track record. Hey, the fees and salaries are too high, something like that. and we eliminate those right off the bat. So you get the benefit of that. Before we bring the deal to you, we vetted it and said, hey, we want to invest in this. You get more deal flow, lower minimum investments because you're aggregating with us, which guess what? The more we invest in a deal, the more power we have to negotiate better terms, and we can pass some of that on to the investor group so that you guys end up getting a better deal. You invest in the same deal, but with us rather than without us, you get better terms on the transaction. And then the big thing, and you'll hear me say this if you listen to us at all, I tell my investors, try to invest in every deal. And then I say every ticker tape deal, and then go find other deals to invest outside of ticker tape, because you want to be diversified. And by the way, I don't mean every oil and gas deal. I don't mean every multifamily deal. Do all the above: crypto, gold, manufacturing, services, tech, healthcare, real estate, non-multifamily real estate, commercial, residential, all those different things. Get that diversification, because that's certainly the name of the game. For you personally, if you're having challenges, if trying to find and evaluate deals is overwhelming, if you've missed out on past opportunities because you didn't have time or you didn't know how, or you couldn't meet the minimum, if you're looking for personalized guidance on deals, hey, I found this deal, what do you think about it? Happy to do that. We do all those things in the ticker tape community 100% free of charge. You see a deal, you want us to help you evaluate it, bring it, and we'll be happy to chat with you. But the first step is kind of to get involved with the community, follow us on social media, attend events like this, the educational events, read the little articles we put out. You can find all that at ttifund.com, which is our website, and then go to the Contact Us page. And at the top of that page, it has links to all of the social media accounts. But we'll talk about all sorts of educational stuff, deal evaluations. I think we did a stock recommendation recently. Sorry, not recommendation, evaluation recently on TDK. Put out the story about Peter Thiel and his $5 billion Roth IRA account, stuff about self-directed IRAs, etc. Make sure you watch all those, but you'll also get access to our deal flow through that process. Then we do free strategy sessions. It's a 45-minute call. You provide us whatever information you want. Could be stuff about your taxes and get our views on how you can reduce your tax bill. I've got a lot of passive income losses that I'm not getting to take advantage of. How can I turn my passive losses into active losses? Is a great one we deal with quite a bit. We're happy to look at your portfolio and make recommendations. Just had a guy who has a $600,000 retirement plan, and then separately he's got an account with $850,000 worth of crypto in it. Nothing wrong with a high-income doctor having $850,000 worth of crypto, except it was way too high a percentage of his overall portfolio. All kinds of things we can talk about. Just go to tti4.com/consult, and it'll give you a questionnaire that you can skip through, put whatever information in there you want us to have. Obviously, the more you give us, the better we can help. And then at the end, there's a calendar link to schedule your consultation. That's all I got for tonight. Reach out to Rita Carpel if you have any questions. Rita at ttifund.com, 832-459-7335. Or, of course, you can always reach us by responding to whatever communication got you onto this presentation tonight. Goodbye to those of you that are here. Hello to those of you out in the future that are watching this recording. And we'll see you guys next week on the next call. Thanks.